Are you tired of the rainbows and butterflies approach in multifamily investing, where everything unfolds seamlessly and everybody wins? You never see behind-the-scenes reality. If you resonate with our perspective, acknowledging that true insights emerge from navigating mistakes and challenges, then you're in the right place. Join Christy Keaton, your host, as she dives into the missteps and lessons learned encountered by active apartment operators. In these episodes, we embark on a journey to dissect and analyze the pitfalls within the multifamily project lifecycle, focusing on the crucial stages of finding, funding, fixing, or flipping a project. Instead of glossing over setbacks, we shine a spotlight on them, providing a valuable learning experience for our audience. Each episode concludes not only by revealing how the issue at hand was rectified, but also by sharing other priceless lessons derived from the experience. It's an unfiltered exploration of the multifamily investment landscape, revealing the intricate tapestry of challenges and solutions that make the journey worthwhile.
Hello, listeners, and welcome back to another episode of Multifamily Missteps. I am your host, Christy Keaton, and I'm so excited today because I have the great Mr. Keshav Kolur with me, and I appreciate him being part of our podcast today. Welcome, Keshav.
Thank you so much, Christy, for having me on. It's an honor to be here.
Absolutely. Now, I know that you've had quite a journey over the last few years for sure. And so I want to start off by just asking you where you started off in the space, how long you've been in the space, and if you can tell us a little bit about your journey along the way.
Yeah, sure thing. You really all started, as it does for many of us, with infamous book, Rich Dad, Poor Dad. I graduated college about 5 years ago, summer of 2019, and I went on a trip, post-graduation trip, month-long in Southeast Asia. So
Love that.
15-hour trip, 15-hour flight one way, right? So I thought, what better way to kill that time than to read Rich Dad, Poor Dad, which I'd heard a lot of good things about. So finished the book, and it really got me thinking about, I know I don't want to work for someone else for the rest of my life. And I don't want just one source of income. I want multiple sources of income. It doesn't involve me picking up multiple W-2s. So for me, that vehicle was real estate. And at the time, I didn't have that much money just coming out of college, and I didn't have experience either. So I thought to myself, hey, why not become a realtor, kill two birds with one stone, start buying and selling homes, make some extra money there, but also learn about the industry. I got licensed leap day of 2020, February 29th.
Love it. Love that.
And then 2 weeks later, as we all remember, COVID shut everything down, March of 2020. When the markets reopened, so later that summer, I sold a few homes. And as I started looking at buying single family homes to rent out and rehab, as a lot of us get started in real estate that way. Luckily, my friend here, actually, my roommate, his dad had invested in syndications, and he came across a Reddit post about someone investing in syndications.
Okay.
And that Reddit author had bought 40 single family homes at their peak. And they said buying apartment buildings is easier, more scalable, more profitable. And I thought to myself, if it's all of those things, and it sounds cooler, honestly, then why not do that instead? So I reached out because no one else that I knew, my friends or my family, besides my friend's dad, had invested in syndications. So I reached out. I did really spend the next year, that was September of 2020 to September 2021, really doing my due diligence, networking with people, analyzing sample opportunities, really getting my feet wet before pulling the trigger on my first investment into 108 apartments in San Antonio.
Okay, that was your first deal, 108 units?
As an LP, I should clarify.
Okay. I was like, wow.
As a passive investor. So there were some lessons learned there for sure, which we could talk about in a bit. But I started seeing the cash flow come in, and I got my tax returns back as well. And I thought to myself, hey, if I'm going to do this for myself and it works, I might as well do it for my friends and family. There's no point in being successful on the beach all by myself, relaxing. I want my friends and family and anyone else who wants to come along for the ride there.
Yes.
So I started my company, Clive Capital, in January of 2022. And our goal is to help a big number, but 10,000 families achieve financial independence. And that would be through passively investing in alternative investments like real estate, energy, private debt, investments outside the stock market for primarily three reasons: superior risk-adjusted returns, cash flow, and tax benefits. And so the goal there is really to build a portfolio for our investors, whether that pays them monthly or quarterly, whether they're traveling, sleeping, hanging out with friends, whatever it is, to build that generational wealth for them. And so far, we've helped people invest passively into 1,000 apartments that we're renovating
Yes.
and over 500 single family rental homes under construction, under development, I should say.
Wow. The single family those are the build to rents that we were
Yeah.
talking about. All right. Awesome. And so you mentioned the diversity of outside of the stock market. You did mention real estate. You also mentioned energy. So what is that about? Just tell us a little bit about that before we go forward.
Yeah, I invested myself, as I always like to do. I put my money where my mouth is, put my
Mhm.
money in first into something new before I bring my investors on. So for me, 3 years ago, that was real estate syndication.
Okay.
This time around, 6 November of last year, that was an oil and gas syndication. So
Love that.
because the depreciation benefits that we get in real estate are great, but you can only take that against your W-2 if you're a real estate professional or your spouse is. But with oil and gas, and to my understanding, energy in general, like even renewables,
Right.
even though I haven't dug that much into it, but oil and gas, definitely, you can take the losses against your W-2 income, regardless of what
Mhm.
your profession is. I'm not a
Okay.
CPA. Just
No, yeah, not a CPA. This is not financial advice. We are just saying, I did not realize that you could actually take the depreciation against the W-2 for any investment. So to know that, that can really help some of the listeners that are starting out in their journey, in their investment journey, and not necessarily wanting to put all of their money into a multifamily investment or real estate in general, but they want it to get that depreciation back on their W-2. That's awesome. That's great to know. Thanks for that nugget. Thanks very
Sure.
much. Okay, so let's talk a little bit about your multifamily journey specifically. You mentioned that you passively invested in 108 units in San Antonio. And as a passive investor, limited partner, I have a few limited partners on the podcast, but I don't have very many. So just tell me a little bit about how everything looked being a limited partner for the first time in a syndication, and how well did that go for you?
Yeah, that was my very first one. And the investment minimum for these syndications are pretty high. So it wasn't easy to wire someone that I had only met through Zoom, never in person, only through Zoom. It was tough.
You're
I
not supposed to do
really,
that.
I know, but I really talked to, I spent a year talking to as many people in the industry as I
Good. That's good.
before I did this. And
Again, not financial advice.
right, right. So that process really involved me talking to this one person, the Reddit author.
Okay.
He hosted a meetup. I went to his meetup, met 20 other investors, syndicators, fund managers, networked with each of them, went to their meetups and kept branching out like that. And I felt like I talked to enough people where I felt confident that, hey, this is a good group to work with for my first investment. And they took a lot of time to answer my questions, point me in the right place. And as a thank you to them, I wanted to invest with them for the first time.
Oh, that's good.
And so I asked for a lot of the details that a lot of people should ask for. Most people, everyone should ask for the underwriting, the financial assumptions, their track record, some testimonials, what the business plan is, the pitch deck, things like that. And the opportunity started out pretty well in the first year or so, but very important lesson, they bought it at 80% loan to cost, floating rate debt. Yeah. So the deal is still alive. And
Good. That's good because a lot of them are foreclosed on.
right. And so I think this is an important thing to note here is that distributions have been paused for a year,
Yeah.
anywhere between 12 to 24 months.
Yeah.
But the partners that I invested with, they've been coming out of pocket to cover expenses, keep the property afloat. So they didn't just throw their hands up and say, hey, we give up.
Good.
They're putting their skin in the game to do right by the investors. But that being said, I think going forward, that is something that I'll look out for. The debt is a very important piece, and things can change in the blink of an eye, as we've seen interest rates just rapidly increase at their fastest rate
Yes.
during 2022. So
Yeah. Yeah. Wow. Wow. Yeah. If you guys don't know about interest floating rates, guys, you need to go and check that out. A lot of colleagues have been foreclosed on due to that. because they sold it to us as, hey, this is the greatest thing since sliced bread. And it looks great on paper, but the reality is floating's not good. It's just not good. If you can't get a fixed rate, it's really not worth even trying. But I am so glad that you have partners that are willing to say, you know what? We did this and we're going to come out of pocket and we're going to do what we can to keep this going. And so that's really good. You have really good partners that are able to do that. That's great. So moving forward, so that's the nugget you guys need to check out, that when you're looking at investing, look at the debt. Look at the debt because it is one of the key components in the underwriting. So moving forward, Keshav, would you say was like one of your major challenges in multifamily in general? Like, do you have more multifamily now? You said 1,000 units. Does that include the build to rent? And what are some of the major challenges that you're facing even today?
Yeah, those 1,000 units don't include the build to rent or the 108 apartment LP
Yes.
investment that I made.
Yes.
Those 1,000 apartments are just partnerships that we've made with other companies who are more experienced than me because I've been in this for 34 years. I make sure that I partner with people who are more experienced than I am and work with them. So I would
Wonderful.
say
Smart.
that's another misstep that you should definitely avoid. Make sure you work with the right people who have a track
Great.
record and good reputation. Those are going well. One of those has stopped distributions as well, even though that one's interesting. We closed on that in 2022. And when interest rates were just going up and up. But during the period when we got our initial quote and after we closed, our leverage was down a couple
Wow.
hundred bips, but in that time. So we had to raise extra capital. Investor returns got diluted. But that I wouldn't say is a misstep necessarily. That's really just a result of the market and where it is, just that rates were
It's a
going
more
up.
reality of where
Yeah.
you are in that position. Yeah. Yeah.
And so what we did was the investors who
Mm.
came in originally, when we originally raised, and we told them, hey, we're projecting whatever, we'll say 15% IRR, keep it simple.
Yeah.
Those people invested thinking that they were going to get that. It's even though this isn't our fault, we should still give them that. So one thing we did there was we eliminated one of the waterfall hurdles that we had and just
Okay.
gave more of the promote from the GP
Mhm.
side to our investors.
That's very kind. That's very kind. A lot of people, syndicators, they may not do that. They may not look at that. But you looked at that and were able to solve that. So that's good. What kind of feedback did you get from your limited partners on that?
That one, yeah. Some of them were happy that happened, that we showed that we operated from a place of integrity.
Yes.
And mistakes will happen. It's always about when one, like, could it have been avoided? And then whether it could have or could have not been avoided, how did you get past that? What did you do? How did you operate? So even though it was out of our hands, I think we handled it pretty well. I did lose one investor, I remember. It was still one of my first capital raises. So it was sad. He had sent the money in, interest rates went up, and going into the deal, it was positive leverage. And by the time interest rates had gone up, it had become negative leverage.
Oh, okay.
And so he really looked for deals with positive leverage, which for those of you listening means that the cap rate is higher than your cost of capital, your interest rate. And I think he had some other things change in his goals and stuff. But I think if it had stayed positive leverage, he would have stayed with me. But I had to wire back money to an investor, which wasn't
It's never
fun.
fun. It's never fun when you lose an investor. It's never fun when they still don't see that there's potential in the deal, even though, yeah. So, but
Yeah.
we all have our standards that we want to live by, and that's just one of them that he wants to live by. So, yeah, that's great. So I want to talk about the build to rent because I'm really excited about your build to rent project that you have going on right now. So tell me, how did you get started in the build to rent? How were you introduced to it? And what made you go, yes, I'm going to do build to rent? Because build to rent, I still have like this, I don't know, it's a mental block or something with build to rent on, can I do that? You know what I mean? So tell me a little bit about how you got started and because I'm excited to hear this journey.
Yeah. Yeah. So that journey ran parallel to when I was finding my first syndicator to invest with. While I was networking, I knew that I didn't want to just raise capital and be a fund manager in this space. I knew I wanted to be an operator and sponsor, actually execute on the business plan. And so I think as I was looking foremost for a partner to work with a mentor rather than an asset class to be a to pick. So, because there are so many asset classes, so many business plans in this space that for me, I think it made sense to work with someone that one had similar values to me, two saw themselves in this space for a couple more decades. I didn't want them to just leave me hanging out to dry in like 3 years.
Yeah.
And three, that three, that they had experience, a couple decades of experience doing this full time. And then four, that they were interested in mentoring people. So I found my partner eventually, Andy McMullen. He really came up with the idea of, hey, let's go after this built to rent thing. And so he's in this for the long term. He's been doing this for a few decades, multifamily, not built to rent.
Yep.
And he loves teaching people. He's a basketball coach. So
That's perfect. That's
yeah.
perfect.
Yeah. So our values aligned a lot. And I said, hey, I was 23 at the time. I'm 23 and I don't have much experience or net worth here, but I have a good background coming from math. Just like I'm pretty analytical. I can help out with underwriting. I'm pretty good at like putting systems together, just like, hey, this person should go do this thing and document it, delegating, things like that. And let's see, I have a good network just coming from a tech background at top tech companies like Amazon and Meta, a lot of well-capitalized investors. And then I'm 23, not married, no kids. So I have all the time and energy in the world. And as long as you're open to teaching me, let me see the ropes. I'd love to help you out. So really, I focused on finding my mentor and my partner. And once I found him, he was saying, hey, I'm doing this built to rent thing. For me, built to rent, it wasn't a hard sell. I think housing is something that I'm very passionate about, much less so than like office space or maybe even self-storage. Not to hate on those asset classes, but
No.
housing is up there on Maslow's hierarchy of needs, right? First, you need water, then you need food, then you need a roof over your head, I would say.
Yeah.
And in this country, at least, even the wealthiest country in the world, we're short 2 to 4 million homes.
Absolutely.
And then just globally, so many more people could use housing. So, and I think it's a great concept where you're marrying the concepts of single family home living and owning and apartment living. It's the best of both worlds where you get your own space, you get your own amenities, your own backyard, your own driveway, but the headaches of home ownership are not on you. The expensiveness of home ownership, especially in today's market with where interest rates are, not on you. And I think the communities, at least the ones that we're building, are a lot more beautiful, in my humble opinion, than cookie cutter multifamily buildings that are just boxes. It at least still reminds you of what the American dream is. So
I love that. I love that you have the value behind that in helping the community because we do need more housing. We all know that the housing shortage is rampant across the nation. So having that is awesome. I just love the build to rent concept. I guess it's a proven concept, if you will, now because it's been going on for a while. And I guess I just need to hopefully break that middle block and jump in with both feet on that one.
yeah,
Just have a good.
we'd love to have you on.
All right. Awesome. That's
Yeah.
great. Okay. So a couple of things. First of all, what's next for you in the real estate space? I know that you're going to continue the build to rent. What else is there for you in this space?
I think it's really my goal to separate it into the two businesses I'm involved in. One is the built to rent stuff where it's really scaling to have more homes under development. Right now we have 500 homes. It'd be great if we could scale up to 2,000 homes, new homes being developed every year across the nation. Right now we're in Louisiana and Alabama, but expanding to other markets.
Okay.
And then on the capital side, just talking to more capital partners and lining up that capital so that when we find these deals, we can join hands from both sides.
That's awesome. That's awesome. I believe that you're going to change this nation just by doing the build to rents. I just know it. So, okay. So I ask a couple of questions here at the end. The first thing is what inspires you most or where do you get your inspiration?
That's a good question.
Make people think on that one.
Yeah, there are a couple of, I don't know, so many people. I would say this is going to sound so cheesy, but my parents, I would say, had a very big impact on me, even though they were never in the investment space full time or in the real estate space. Growing up, they always told me to think for myself, don't follow the herd. I think that's backfired on them a little now because I'm thinking for myself a little too much. Even sometimes when they're like, "Are you sure?" But I think that's one of the big mindsets that you need to have in life to grow is just always think for yourself and don't do what everyone else is doing. Because if
Yeah.
you do what everyone else is doing, you're going to get the same results that everyone else is getting. And those results, for me personally, at least, aren't enough. I want to do more. So,
Yeah. Having your parents as an inspiration is not cheesy. I'm just saying. It's not. They should be your first inspiration if they were good parents. And it sounds
yeah.
like that you had a good background. So that's awesome. Okay. Besides multifamily missteps, what other podcast do you recommend somebody listen to?
Yeah. A shameless plug. We have our own podcast, Investing for Generational Wealth, but it is shameless. So for other less shameless plugs, the podcasts that I learned the most from, let me think here. I'm not a big podcast person, honestly. I like my books more.
Next question. So go ahead and pick one of those out too.
Okay. I'll take that one's a lot easier, but podcasts, there's so many out there. The best ever show, I believe.
Yeah.
Jim Wellness, that's a good
Yeah.
one.
I like that one too.
Hunter Thompson's Cash Flow Connections. That's another one that I really like.
Good.
Yeah.
Okay.
And I guess Bigger Pockets. You can never go wrong with that.
You can never go wrong with Brandon Turner's guys. You just can't. He's a good guy and his podcast is great. So, okay. So what book do you recommend for either multifamily real estate or real estate in general, investing in general? But you can throw out a couple of books if you want to throw them out.
Yeah, I would say the number one for investing is probably The Hands-Off Investor by Brian Burke, published by Bigger Pockets. I think the book is mostly centered around multifamily real estate, but you could really expand that to any asset class that you want. Because first and foremost, the book teaches you how to evaluate the people that you're working with. And that's the most important aspect to it. I don't have to be an expert in multifamily and built to rent and industrial and private debt and oil and gas. That's too much. It's all about building a team with the right people where hey, I might know 25% of this. As long as someone else knows 100% or 90%, I can rely on them and their good person integrity, etc.
I've always said if you find the right team, you'll do great, right? So your team is really what's going to push you. So you don't have to know everything. Delegation is great. Having a network of people that knows the business is fantastic. So, okay, Keshav, how do my listeners get a hold of you?
Yeah, so I'm active on LinkedIn. Will be more active, but that's the best way to get a hold of me. If you just search up my name, luckily it's a pretty unique name, and you'll find me on there. It's just my profile is just first name, last name, or my username, whatever you call it on LinkedIn.
Yeah.
And besides that, our podcast, Investing for Generational Wealth, it's on all major platforms, and we upload the video to YouTube as well. And lastly, go to our website, clivecap.com. And Christy, if you don't have these links, I could send them to you.
We'll have all the links in the show notes whenever we drop it, and we'll let you know.
Yeah. It's
CLIVE, right?
CLIVECAP.com and then /alternative-assets. So for a lot of people who are just getting into the space, it's scary to invest outside the stock market, just like it was for me 4 years ago. And so I put together a couple of resources for people. One of them is a due diligence checklist of 100 questions that you should be asking someone, regardless of what you're investing in, whether it's oil and gas, or it's real estate, or it's private lending. These questions apply. And we then have a 2-pager that's about a 5-minute read about some big reasons you should be investing outside the stock market. And if I haven't bored you to death by then, there's a maybe 20-minute read ebook that goes into more in-depth about why you should be investing outside the stock market.
That's awesome. Well, Keshav, thank you so much for being such a great guest and dropping some nuggets for the listeners. We appreciate it very much.
Yeah, thank you for having me, Christy. And I'm glad that I was able to educate some folks and deliver some value.
Absolutely. Guys, if you're interested in investing with Clive Capital and Keshav, look him up. He's going to be waiting for your email. We'll talk to you soon. Have a good one. Thank you for listening to another episode of Multifamily Missteps. Your dedication to our podcast is truly appreciated. Please help us spread the word and make our community even stronger. The valuable lessons that our guests bring each episode will help you and others avoid these missteps along your journey. Hit the subscribe button, take a screenshot of the episode you just listened to, post it on your social media, and tag myself and my friend Jerome Myers. You never know, you might find yourself our next featured guest. I cannot wait to continue this journey with you. Until next week, stay tuned and stay inspired.